in partnership with CommSec.
Joining us from CommSec now is Tom Piotrowski. Tom, good morning. How are the markets taking the news this morning after the worse than expected US GDP figure?
Kenny, you're well informed. That was a really important catalyst in the early stages of US trade. Indeed, there were several reports that spoke to the moderation of the US economy over the course of the first 3 months of the year. The GDP figures were just one aspect of it, but to see that contraction of 1/3% for the US economy, which was below the market's expectations, was a bucket of cold water. But then we also saw measures of private employment and manufacturing, which were also well below the market's expectations. So when you look at the graph of the performance of the share market over the day, you see that initial plunge, and that was the driver for that. At one stage, you had the Nasdaq down by close to 3%. The S&P 500 was down by about 2.3% at its worst, Kenny. So over the course of the rest of the session, the belief that this would then spur the US Federal Reserve into cutting interest rates supported sentiment. There was a recovery, and actually quite a good one. By the end, we saw the S&P 500 down only 0.2%, and the Nasdaq down by 0.1%. The interesting thing is, Kenny, that after the market closed, we saw better than expected earnings from Meta and Microsoft. So at this stage in after hours trade, you've got those US futures moving higher by a decent margin. So the futures are initially pointed to a lower start for the ASX 200, down by around 0.2%. But if those US futures continue to move higher, we could actually be in for something closer to a flat start. So that's something to look out for. There were a whole host of commodity prices that were under pressure last night, including oil. So that was one of the worst performing sectors in the Northern Hemisphere, with energy prices down by around 3%. So that's something that's worth keeping in mind this morning. The Aussie dollar is trading back above 64 US cents.
Thanks, Tom.